Hey everyone, and welcome to your second video on taxes. We learned about what taxes are and the purpose of taxes, and now we're going to start talking about filing your taxes. But before we can actually file our taxes, we need to go into all the different terms and the different forms that we're going to be using. So we're going to talk about that today. Each year, individuals must report the information about their wages and/or income earned to the government. Your taxes must be completed and filed by April 15th. Each year, by the end of January, you will receive a Form W-2 from each employer. This is the wage and tax statement. It states the amount you were paid during the previous year. Alright guys, let's take a look at Form W-2. As we can see here, we have our employee identification number. We also have our employer's name, address, and zip code. This is where we worked. We have our social security number, and we have our address and name. Up here at the top, we have two boxes, and you can see they're in a darker outline than all the other boxes. That's because they're very important. All right, this is our wage, tips, and other compensation. This is the amount that we made throughout the entire year. We also have our federal income tax withheld. This is the amount that was withheld from all of our paychecks this year. Now we need to decide which form we are going to file, right? When filing a tax return, you will use one of three common forms. There's the 1040-EZ, the 1040-A, and the 1040. You can generally use the 1040-EZ if your taxable income is below $100,000, your filing status is single or married filing jointly, you are not claiming any dependents, and your interest income is $1,500 or less. If you can't use Form 1040-EZ, you may qualify to use the 1040-A. If your taxable income is below $100,000, you have capital gains distributions, you claim certain tax credits, and you claim adjustments to income for IRA contributions and student loan interest. If you cannot use the 1040-EZ or the 1040-A, you'll probably need to file the 1040. The reasons you must use the 1040 include your taxable income is $100,000 or more, you claim itemized deductions, you are reporting self-employment income, and you are reporting income from a sale of a property. Filing status describes your tax filing group. Okay. You must mark one of these as your filing status on your tax form. You can check single person, which means you're not married, a married person filing a joint return, a married person filing a separate return, head of household, or qualifying widow or widower. Adjusted gross income. The law allows you to subtract some types of spending from your income. You can adjust your income by subtracting such things as contributions to individual retirement accounts, student loan interest, and tuition and fees. These adjustments are subtracted from gross income to determine your adjusted gross income. These adjustments reduce income that is subject to tax. The 1040 is the only form that allows you to deduct every possible adjustment. Using 1040-A significantly reduces the number of available adjustments you can take. And if you're filling out the 1040-EZ, your adjusted gross income is the same as your total income, since the form doesn't allow you to deduct any adjustments to income. This is how you calculate adjusted gross income. All right, we have our gross income minus our adjustments. Taxable income is the income on which you will pay tax. Taxable income is your adjusted gross income minus deductions and exemptions. You can either claim the standard deduction or itemized deductions, which means you list them all out, whichever lowers your tax the most. The standard deduction is a fixed dollar amount that reduces the income you're taxed on. This amount changes each year. Itemized deductions are expenses that you can subtract from adjusted gross income to determine your taxable income. Examples include medical and dental expenses, state and local income taxes, property taxes, home mortgage interest, gifts to charity, losses from theft or property damage, and moving expenses. An exemption is an amount you may subtract from your income for each person who depends on your income to live. Each exemption reduces your taxable income and thus the total tax you owe. You can claim the following exemptions: yourself, unless someone else claims you on their return, your spouse if you are filing together, and your dependents. Remember, a dependent is a person who lives with you and for whom you pay more than half of his or her living expenses. A tax credit is the amount subtracted directly from the tax owed. A tax credit reduces the tax itself. The government allows tax credits for certain education expenses, childcare expenses, and other reasons from time to time. Now, let's make sure we understand the difference between a tax credit and a tax deduction. A tax deduction is subtracted from your gross income. So it reduces the tax by reducing the amount you're being taxed on. A tax credit is an amount subtracted directly from the tax owed, so it reduces the tax itself. So we're going to use the following 8 steps when we're calculating our income taxes. First, we're going to determine your total income. That should be on our W-2. Then we're going to determine and report your gross income after subtracting any exclusions. You're going to subtract your adjustments to income. Then you're going to subtract either the standard deduction or itemized deduction, whichever one is more. You're going to subtract the value of your personal exemptions. You're going to determine your preliminary tax liability. You're going to subtract any tax credits for which you qualify, and then you're going to calculate the balance due to the IRS or the amount of your refund. Every year, the IRS calls millions of taxpayers for an audit. This is an examination of your tax returns. There's 3 different types of audit. There's a correspondence audit, which is minor questions. There's an office audit. This is at an IRS office. And there's a field audit. This is the most complex. Okay? IRS agents actually visit you at home, your business, or your accountant's office if you used an accountant. If you claim large or unusual deductions, you are more likely to be audited. Failure to pay taxes. I know I mentioned this in the last video, but failure to pay your taxes can result in a penalty, interest charges on the tax owed, plus a possible fine. Willful failure to pay your taxes is what we call tax evasion, which is a serious crime. It is punishable by a fine, imprisonment, or both. Remember, taxes are complicated, I certainly can't deny that, but millions of Americans like you file and pay them every year. Understanding the basics can help you save a lot of money over your lifetime and save you a lot of stress too. Alright guys, that is the end of this video. Just remember to bring your notes to class. See you there.